All right, so in this video, I wanted to answer the question, what would happen if we sold a put spread every week on Amazon, a put credit spread, and out of the money put credit spread at short strike being the expected move on Amazon every Friday, and then the expiry being 28 days later. So a similar video to the past 2 or 3 videos I made on the SPY, Tesla, and Netflix, but this video will be on Amazon. So we're going to extract the historical data on Amazon. I'm going to go to Yahoo Finance, click on Max over here. So Amazon goes back to 1997. So we've got about 24 years of data. I'm going to click apply, and then I'm going to click download. I'm going to open the downloaded spreadsheet and just wait for it to load, and then I'm going to remove, or I'm just going to keep. So I'm going to remove the highs and lows of the day. I'm going to keep open, and I'm going to keep close because I'm going to compare the opening price to the closing price. I'm going to remove these 2 columns here, adjust the close. And now I'm just going to look for the Fridays because the idea here is to be mechanical, and it would be opening a put spread every Friday with 28 days to expiry. So I'm going to look for Fridays first of all. So weekday is the formula to be used. Serial number would be the date that the cell with the date, and then I'm just going to pick the format number 2, I believe. Click enter, and digit 5 should be the Friday. So just to make sure, May 16 is a Friday, because you've got 3 days later, you've got May 19, which is a Monday. So 19, Monday, Tuesday, Wednesday, Thursday, Friday, and so once again, May 23rd is a Friday, which is number 5. So now I'm just going to keep the Friday. So I'm going to remove everything else. So I'm going to select everything, or unselect the 5 and select everything, and delete everything, so that I'm just left with Fridays. All right, so now that I just have Fridays, I'm going to compare Friday 28 days later, or 4 weeks later, to Friday, the first Friday here over here. So May 16. So 1, 2, 3, 4. So I'm going to compare this Friday closing price to the opening price of this Friday. So June 13 Friday compared to May 16 opening price on Friday. So it'll be just a simple formula here. So this value here divided by this. I'm going to remove 1 just to get the movement, the difference, the variation. And then I'm going to round. I want to round to 2 values, to 2 decimals. I'm just going to put the parentheses now where they need to be. So over here. And then if I add round, I'm going to need another parentheses and then another one over here. So basically this means over here that Amazon, compared to opening price 196, it actually dropped 20% 28 days later. So that's pretty high actually. So let's just double check here. So let's just double check. So 1.65 divided by 1.96, I should get 80%, about 84%. All right, so I'm just gonna apply the formula across all the cells, all the lines here. And now I've got all my values. So I'm gonna select all the values, and I'm just paste it in a different sheet, paste as values. And now I'm just gonna count how many times these movements, these differences occurred. So I'm just gonna count here, equals count if the range is this here and the criteria is this individual cell. So basically this means that there were 5 occurrences, or 5 different 28-day periods where Amazon dropped 20% if you compare from one Friday to another Friday. And this means here that there were 29 different 28-day periods where Amazon was up 9% if you compare from one Friday to another Friday 20 days later. Okay, so now I'm just gonna copy paste the value as the values as values, remove the formulas basically, so I can remove the duplicates. So A, B, and I'm just gonna sort here from largest to smallest just so that it looks nicer. Now I'm gonna remove the duplicates. So I'm gonna highlight, because as you can see 76, I have 2 lines that show a 76% move. I have two lines that show that it occurred 2 times, so I don't need to see that. I just need to see it once. So I'm just going to remove the duplicates. And now I should have only one line that shows me the same information. Okay, for example, here it shows that Amazon was flat 28 days later 43 times. So now I'm going to count. I'm going to look at the percentage that each of these movements represent compared to all the movements in the past 23 years. So I'm just going to do a comparison percentage wise. So this divided by the sum of the column, and then I'm just going to apply the formula all the way down. I'm going to change the values into percentage. I'm going to make sure I'm going to add 2 decimals. So basically, once we go back down to the 0 line, where this means that Amazon 28 days later was trading at the same price. So that happened 3.55% of the time in the past 23 years or 24 years. Now let's see how many times it was either flat or higher. So basically I'd be adding all these percentages. So I'm just going to put a formula next to it that adds it up, and I'm going to apply the formula all the way down. So the last value, if this is correct, should give me 100, because basically this is just adding up all the percentages. So this here basically means that Amazon has never dropped more than 43% of its value 28 days later. Well, if we compare, I don't know, Netflix or Amazon, Netflix was around 49%, and Tesla was about 53%. There was an occasion where it dropped 53% 28 days later. So going back to Amazon, so now I'm just going to put some nice colors here just so that it's easier to see. All right, so if we go to the 0 flat here, so it shows here that 62% of the time Amazon will trade at the same price or higher 28 days later. So basically it's almost the exact same probabilities as the other stocks here, as this one's Netflix 62% exactly, and then Tesla was 59%. So Tesla was a little bit lower. Now let's look at, let's look at 3% lower. So 3% lower gives us a 71% chance of being out of the money. And let's go find the 80%. So 80% is around 7% lower, and 90% is about 13% lower. So if we go back to the 80%, this basically means that 80% of the time, 28 days later, Tesla will not be trading 7% lower than the current market price. So if we look at the price of Amazon right now, it's trading at $37.29. So that means that there's an 80% chance that Amazon is trading above $37.27. So assuming today's a Friday. So if today's a Friday, there's an 80% chance or an 81% chance based on past prices. There's an 80% chance that Amazon is trading above 34.66 come Friday in 2 weeks. Not 2 weeks, sorry, in 4 weeks. So in 28 days later, there's an 80% chance that Amazon is trading above 34.66, which is 7% lower of the current market price. So that's what this means. So if we have this information, basically it means that we can sell a put spread at around 34.66, and we have an 80% chance of winning. So let's go see in Questrade how much we can collect out of a 34.66 put spread, which is 28 days later. All right, so the closest expiry I have to 28 days later, because we're not Friday today, would be 31 days later, which is August 13. You can see that the expected move is about 260 points, and Amazon's at 27.30. So 37.30 minus 260 is the expected move. So that puts me at exactly 34.70. And remember, we said that we wanted a 34.66. So that's pretty good. So that in this case, in this example, the expected move on Amazon for 28 days later is exactly 7% lower than the current market price, which I know has an 80% chance of winning. So if I were to sell a put spread at what was the strike again? 34.70. Let's go see how much I can collect. If it's 5-point wide, I should be able to collect $1. So 34.70 I said. So where is 3470? Why? Yeah, that's weird. August 13th does not have the 3470 expiry, so that's a problem. So if I wanted the 3470, yeah, so you know what? It's just not available for some weird reason. It jumps from 3500 to 2990. So I guess we can try a different expiry. I guess we can go to August 20th just for example purposes. But in that case, I want to see what the expected move is for August 20th. So August 20th expected move is at a 37.30. So the closest expiry is 37.50. It's about 280 points. So we're going to do 37.30. 37.30 minus 280 points is about 34.50. So now let's do a 34.50 put spread. 34.50, 34.45, 5 point wide. I should be able to collect $1. So this means that I'll probably be able to collect about 80 cents, 90 cents. And as you can see, it's changing. So I could probably collect $1 or maybe 95 cents. So right now, yeah, 95 cents. So yeah, so this put spread here basically has an 80% chance of winning. That's what this table means here. So if you want it to be mechanical, a trade you could do is sell a put spread on Amazon every Friday, 28 days to expiry. Sell it at this range. Sell it at this range about where your short strike is about 7% lower to get at least an 80% chance of winning. Depending on the expected move, sometimes your short strike will be even lower, giving you a higher chance of winning. So expected move will depend on the volatility in the stock. If there's earnings or anything that might cause extra volatility in the stock. Amazon, I think, has earnings in July. Yeah, and earnings date is in the week of July 28th, August 2nd. So our expiry included earnings, so that's why expected move was a little bit higher, putting me at the 80% probability. But it's always best to have a probability of at least 80% chance of winning, in my opinion. I that's my preference in terms of short strike selection. So let's look at a 3-month chart on Amazon and let's try to simulate or backtest a bit this strategy. So we've got April 16, 2021 is a Friday. And if we say expected move, obviously that the difference is, or the problem is, I don't know what the expected move was back then. But if right now it's around 7% of the current strike, of the 7% of the current price. So open price is 33.80, and if I want to go 7% lower, that means I would choose a strike of about 31.40. So I'm back here, April 16. I open a put spread with 28 days to expiry. My short strike will be 31.40. So 28 days later will be about May 14. So let's go to May 14. Let's see where Amazon's trading at. Amazon closes at 32.22. So this would have been a winning put spread. So that's for this Friday. So that's for the April 16 Friday. So now we move on to the next Friday, which is April 23rd. Amazon's trading at 33.20. So what is 7% lower? So it's about 93% of 33.20. So it's about 3,100 or 30.87. So 28 days later, after April 23rd, it puts me at around May 21st. So May 21st, Amazon's trading it closes at 32.03. I said I wanted my short strike would have been at 3,100. So I would have had 2 winners in a row in this case. And we move on to the next Friday. So April 30th is the next Friday. Amazon's trading at 3,500. I'm going to pick a strike that is 7% lower. So 35 times 3,500, I said. So 32.55 would be my short strike. So let's go back to April 30th. So 32.55 would be my short strike at May 28th. So let's go to May 28th. Amazon is trading at, or closes at 32.23. So looks like this one seems to be a loser. Yeah, 32.55. So this one would have been a loser, but by very little, by 25 points. So either I would have taken max loss on this one, or I could have sold a call spread to reduce my max loss. So selling a call spread on the other end to collect extra credit, making sure it's the same expiry, same width of a spread, so that I don't lose on both ends. And this way I'll collect extra credit and reduce max loss. I probably could have done it when Amazon dropped all the way here. So I've got 2 winners in a row, and the third one is a loser. But then next Friday is May 7th, I believe. Yeah, May 7th. Amazon's trading at 33.20. My short strike will be, if Amazon's at 33.20, my short strike will be at 93% of that. Will be at, once again, 3,100. So May 7th and 28 days later is about June 5th. So if we go to June 5th, Amazon is trading at, or June 4th, Amazon's trading at, or closed at 3,200. Remember I said I wanted a short strike of 37. So this one would have been a winner. So basically one max loser is equivalent to 4 winners. And that's if you don't manage your loser. That's if you don't sell a call spread against your put spread that is a loser, to reduce the max loss. So if you just go to expiry regardless, it would take about 4 winners to make up for one loser. So we had 2 winners, 1 loser, and then another winner right after. And now if we continue, the next Friday will be May 14. May 14, Amazon's trading at 31.85. If we take a short strike, that's 7% lower, so that's 0.93 times 31.85. That's 29.62. So I want my short strike will be at 29.62, and I said my expiry will be June 12 about. So June 11th, Amazon's closes at 33.46. So we have a winner. Next expiry, we will go to May 21st. Yeah, May 21st. So Amazon's opens at 32.50, and if I want 7% lower, that'll be 0.97. So that's 31.52. Actually, that seems wrong. 0.93. Yeah, 32.50 times 0.93, because I want 7% lower. So my short strike will be at around 3,000. I said we were looking at May 20. Which date we were looking at? We were looking at May 25th, 6th, 7th, 28th. So we're looking at May 21st. So now 28 days later will be about June 19th or June 18. And I said my short strike needs to be above, or Amazon needs to be above 30.22. So if we go to June 18, Amazon is trading at, or closes at 34.86. So there we go, another winner. And if we continue now, our last Friday was May 21st. Yeah, so then the next one will be 27, 28. So yeah, May 28th will be the next one. Amazon's at 32.42. And I don't think I have to continue, because you could tell from the chart that it's just upwards from there. So June 26th, Amazon is above it easily. It's even above the current market price here. So you can obviously tell that an out of the money put spread would have won. Same thing here, same thing here, same thing here. And then after that, we don't have 30 days yet. We are July 13, so the further back I can go is around mid-June. So the next Friday, the June 11th here, Amazon is at 33.49. If I take a short strike at 7% lower, so 0.93 times 33.49 puts me at 31.14. So basically I want Amazon to be above 31.14, and Amazon right now is at 37.23. Or last Friday it was at 37. Where's last Friday? So I want last Friday, which is July 9th, and Amazon is at 30, it closes at 3,700. So there you go, another winner. So just in this 3-month period, you could see that we had one loser and all the others were winners. So that's just in this 3-month period, and that's if you're choosing a short strike that is 7% lower, which puts me at the 80% probability of winning. And that's assuming that you can collect, that the expected move is in fact 7%. Because if the expected move is 7%, you will collect close to $1 for every 5-point wide spread. Sometimes the expected move might be bigger and your short strike is even further, making your trade even safer, giving your trade a better chance of winning, but you'll still be collecting $1 at expected move. Sometimes it will be lower. Expected move might be lower, so then you'll be closer. You have a smaller probability of winning, but and you might even collect less than $1. But that's what these probabilities mean. I mean, you could skip it sometimes if you feel like you're way too close to the current market price. But the whole point of these strategies here is if you want to be mechanical, if you want to be completely mechanical, have a strategy where you don't care if the market crashes, because yes, your existing put spread would lose, but you have protection because it's a put spread. So there's a long put in the spread, but then you're opening a new spread on the next Friday, which now has an even better chance of winning. Well, you'll collect more premiums because volatility has gone up. So that's one approach that you can use if you want to be mechanical in terms of selling options. If you want to try to make it a passive income strategy. I don't know, if we go back and just pick a different 3-month period, you can see just from the chart that all these put spreads here, week after week, would have been winners just from the chart. This one as well. This one, maybe this put spread would have been a problem. Put spread that you open up here. Actually, let's check. So February 12, 13, 14. So February 14 is a Friday. Amazon is trading at 21.55. If I take a strike that is 7% lower, so 0.93 times 21.55 is 2,000. So I want a short strike that's above I want Amazon to be above 2,000 come 28 days later. 28 days later is about March. March 10th, let's say, because February is 28 days. So let's go to March 10th. Oh, this is 2020, so this is one of the worst examples. Yeah, this is March 2020, so that let's not count that because it's one of the worst events ever in history. So actually, we said I wanted a short strike. I wanted Amazon to be above 2,000. Amazon was at 1891 28 days later. So even in March, it wasn't that far off. So this put spread would have been a loser, but for sure the next one here. So after February 14, the Friday that comes after February 14 is February 21st. Amazon's at 20.95. So that means my expiry will be about March 18 or something. So my expiry will be March 19. No, March. So I've got 7 days in February, and I need to add 28 days. So I need 21 days. So my expiry will be March 21st about. Okay, so March 21st. Or March 20th, Amazon's trading closes at 1846. Now, if I go back to February 21st, Amazon's trading at 2142. So if I want a strike that is 7% lower, so my short strike will be 1992. Yeah. So in this case, the next put spread would also be a loser, but it was pretty close. And the next ones you can definitely see from the chart that the next ones will be winners, because after February 21st, the next Friday will be February 27th, I believe, or 28th. Yeah, February 28th is the next Friday. So Amazon's trading at 1814, and you could obviously tell that 28 days later, which puts me at around end of March, Amazon is trading at or closes at 1963, and the stock was trading at 1883. So definitely an out of the money put spread here would have been a winner because Amazon was trading above at expiry. Over here, Amazon was trading below. My put spread would have been breached, but if my plan is just to hold to expiry, this put spread would have been a winner. And then the next ones as well would have been a winner, because you could see that 28 days later, Amazon ends up being above the current market price before I open my put spread. So even in the worst times, even in the worst 3 weeks or worst month ever, you could see that this mechanical every week put spread 28 days to expiry would still generate profit. Not all the time, but if you look at the overall P&L, it would still generate profit. So this is coming out of March. So obviously we had a good bull market right after March. So look how many put spreads would have won. How many 3-month periods you would have had put spreads with winners, being winners. And then over here, obviously this one here, if you open the put spread right above here, it's probably not going to be a winner because 28 days later, although it's pretty close. So let's look at it. August 31st, September 1st, September 2nd, 4th. So September 4th, actually, where's the Friday? August 26th, 27th, 28th. So 28th, August 28th would have been over here. Amazon's at 3,400. 28 days later would be about September 26th. So September 26th, Amazon is trading at, or September 25th, Amazon closes at 3,000. So this one would have been a loser because of the 28 days later. But you can even choose a different period. You could do 6 weeks if you prefer. And you could tell here that at 6 weeks, this put spread would have been a winner. But the probabilities I'm showing is for 28 days. But I've done the comparison before. If I make it, for example, 7 times 6, if I make it 42 days later, the probabilities are going to be very close. It might be maybe 65% over here, or maybe 60%, but it's going to be very similar to these probabilities. All right, so this is an example using Amazon and put spreads, how you can turn option selling into passive income strategy. So if you have any questions, leave in the comment section below. Also check out the previous videos because they're very similar to this one, but they talk about different stocks. Like always, if you can open an account with Questrade to sell options, use my referral link below to get $50 in free commissions. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.